Welcome back to this 10th lecture of the Economy Crash Course series. In this particular video, we will be looking at the issue of non-performing assets and what the economic survey talks about this. Before that, we'll get into certain basics. In the previous videos, we have discussed about these developments. We have also talked about the NBFCs, we have talked about the banking sector, we talked about the government securities and the development in capital markets as well. So, if we have to talk about the credit growth in our economy, we have to discuss the issues of NPA. But before that, we'll be discussing certain basics. When you look at a bank's account books, the basic accounting equation would be something like this: share capital plus liabilities is equal to assets. Now, it is very difficult to understand this accounting equation, so let us come from the basics. Imagine a glass tumbler which is having a capacity of holding 1 liter of water. Now, this 1 liter is considered to be its maximum possible capacity. If we are taking a similar analogy, authorized capital is that capital which is the maximum possible amount of shares that a company can issue to borrow money from the markets. Let's say initially, again going back to this example, this is the actual amount of water which is present in the tumbler. Drawing parallels, we can say that this is the amount of shares that the company has already issued into the market. Initially, when a company is new, promoters or the founders of that company will have maximum amount of share. Let's say for example, they're starting a company with 100 rupees of capital and they want more money. So this 100 rupees of capital was equal to 100% share of the company initially. Now this percentage should be brought down to revalue the company, showing a future prospect. So when the company goes into the market, the value of the company increases. Similarly, if the company wants to raise the cap of authorized capital, it has to take permission from the government, and certain audits will be done to ensure that the valuation of the company is indeed right. So the reason why we are talking about all this is because it is linked to the concept of capital. Now, what do you mean by capital? It is the initial investment for any company, and similarly, even for financial companies, there will be some capital. How does a banking model work? We have already seen. Let's say, for example, a depositor X gives certain money to the bank gives that money to Y and gets certain interest. Let's say, for example, X deposits in a bank 100 rupees, and the bank uses the same 100 rupees and gives it to Y at, let's say, an interest of 10% and says that X will get an interest of 4% for using the money that X gave to the bank. So this 6%, 10 minus 4, 6%, whatever interest that the bank gets is its income. Now, in order to accept this deposit, initially the bank should invest some money to build the building of the bank or to give salaries to the employees, etc. That money to start a business of banking is called capital. So there are certain international standards for maintaining the capital adequacy, and how non-performing assets will erode the capital is what we have to understand now. Understand two terms: prime and subprime borrowers. Prime means they can repay the loans, subprime borrowers means they can't repay the loans. Now, subprime borrowers are reason why the 2007 2008 global financial crisis came into existence. What happened in 2007 was, in US, a lot of banks gave cheap loans for consumers for buying homes. So these cheap loans were called as teaser loans because the reason for their success initially was, initial years the interest that they have to pay is very low. What happened in the US was, one after the other, banks went on lending to these subprime customers, and because of this, nobody was in a position to pay the loans back to the banks. So what happened was, all the money was stuck in homes which were occupied by nobody, and this not only led to the real estate crash, but also the entire banking system came under a huge pressure, which triggered a global financial crisis. So, in this context, the main issue that we have to understand is non performing asset. Now, the main reason why the global financial crisis came into existence was the asset, that is the loan given by American banks to the consumers, did not yield or did not perform and give the expected returns. So, non performing asset is the single most important problem that a bank should address, because it is the fundamental problem of a banking industry. Also, note the 2008 global financial crisis is also called subprime crisis because of this reason. Now, it's very clear that companies require certain amount of money as capital. Companies take loans for that capital. Now, that economic activity should generate not only the profit but also additionally the interest amount that these companies owe to the banks should also be paid back. So, they have to make that much amount of money. Here is where banks use a very important parameter called the interest coverage ratio to decide if these companies are worthy enough of giving further loans or not. Let's say a company is asking for a loan. So the banks take a look at the earning potential of the company, and let's say if the profits before taxes and everything is, let's say, 10 lakhs, and the interest that they have to pay over a period of time is 5 lakhs. So they have an interest coverage ratio of 2, which is decent enough. Now imagine a scenario where they do not even have this money to pay the interest. Let's say, what if it is 3 lakhs? It is less than 1. This is not an ideal scenario or an ideal way of running a business, because a good business is something that generates more money than what it actually borrows. If this is not the scenario, then you can safely say that it is a risky business or a bad business. Now, the reason why we are talking about this term ICR is because Economic Survey in 2020-21 has talked about the poor ICR ratio of a lot of loans or a lot of companies which took loans from our Indian banks. Let's say from 2007 to 2008 till 2014-15, RBI noticed that a lot of banks were in a zombie lending mode without taking a look at the ICR. So this resulted in RBI taking stringent steps. So what happened in 2014 was AQR, that is asset quality review. Assets for banks are nothing but loans. So RBI directed the banks to have a look at the quality of the loans that they are giving to various companies. So this is the time when the issue of non-performing assets started rising and reached a peak of 17% of total assets per our public sector banks. So talking about this, in Economic Survey 2016, we call this crisis as the twin balance sheet syndrome, because the banks were exposed to bad businesses, not only the companies but also the banks. Both the balance sheets are under severe stress and economy was under severe pressure. So it is upon RBI, the government and all the stakeholders involved to get out of this cycle of non-performing assets and zombie lending. So this is the issue, the beginning point where Indian economy, especially the banking system, saw a reversal in its asset quality review. For banks, assets are loans. Now assets should give certain returns. Non-performing assets means they are not giving returns as expected. So let us understand certain definitions. Standard asset, it means that the borrower is paying both the principal and interest on time. So there are something called special mention accounts. There are three types. So if the principal and interest is not paid for 1 to 30 days beyond the due date, then it is categorized as SMA 0. SMA 1 and SMA 2 are respectively 31 to 60 and 61 to 90. If principal and interest is not paid for more than 90 days, then such an asset is called a non-performing asset. So this 90 days is not for agricultural loans. Please remember this. This is for other kind of loans. Just remember this exception. Now, if this asset remains a non-performing asset for 12 months, it is called substandard, and if it remains substandard for 12 months, it is called a doubtful asset. And an auditor will review this doubtful asset and look at the scope of recovery, and if he sees that there is absolutely no scope for recovery, the auditor will declare it as a loss. Just like our RBI, every country has a central bank. So 60 such central banks came together and formed the Bank for International Standards with its headquarters at Basel in Switzerland. The main function of this bank is to ensure banking supervision for maintaining global financial stability. In different periods of time, different set of norms were proposed by this Bank for International Standards, and they are called Basel I, Basel II, and Basel III. In the pretext of the 2007-2008 global financial crisis in 2011, Basel Committee has actually proposed the third set of norms for safeguarding the global financial stability. In order to comply with the same, in 2013, RBI proposed that even Indian banks would adopt these Basel III norms. Now let us look at these Basel III norms and why is it relevant in our present discussion. Now let us understand about the capital. Anytime when a bank gives a loan to a particular customer, there will be risk assessment involved. Let's say for a loan X given to a customer, the bank thinks that there is a 10% risk of failure of that particular loan, that is 10% chance of that loan not coming back. Okay, so if a particular customer Y is given a risk weight of 15%, then there is 15% chance of that failure, and 20% is the risk associated with a customer Z, then 20% is the weight given to that particular customer. Now, when we are talking about capital, according to the Basel norms, there is something called CRAR, that is Capital Risk Adequacy Ratio. So this concept says that whenever bank wants to lend, there is a minimum amount of capital that a bank should keep with itself in order to carry out that business. How much is that capital is the question. That is determined by the CRAR, that is the Capital Risk Adequacy Ratio, or simply called the Capital Adequacy Ratio. So this concept says that the capital that a bank should have is nothing but a certain X percent of the total risk weighted assets. So in this particular example, for X, Y and Z together, depending on the risk percentage they have, the risk weighted assets, if you sum them up, that is something like 0.1x plus 0.15y plus 0.2z, a number would come, right? So within that, an X percent should be maintained as capital is what this concept is. Now the Basel III committee has actually given a number for this CRAR. CRAR as per Basel committee is 8%, but RBI has actually said that this should be 9% for scheduled commercial banks, and if it is a public sector bank, it should be as high as 12%. This is one concept. Let us now talk about the concept of provisioning. Even this is something similar. Now let's say bank has already given loans to different customers and the corresponding risks associated with those particular assets is given here. So the concept of provisioning says that whatever is the risk percentage, let's say 10% is the risk associated with the asset X. This asset X is worth 100 rupees, let us say. So the next time a new loan is to be given, before a loan is given, out of the remaining deposits, this 10 rupees should be kept aside. Similarly, if 15% is the risk associated, then 15% should be kept aside. 20%, that is 20 rupees, should be kept aside. So in the new set of deposits, if we have, or in the existing set of deposits, if the risk associated is worth totally 20 plus 15 plus 10 45, at least 45 rupees should be set aside as a provision just in case these loans fail. Now what happens when these loans fail? The provisioning of that particular loan will actually become 100% of the given loan. Let's say the risk is 10%. If it actually becomes a non-performing asset, it will become 100% because it is not yielding any return, and in fact the entire amount is eroded. It is a sort of a loss for the bank. Note the point that the risk weighted assets is just an accounting concept. It is not actually kept aside by the bank. It is just an accounting concept. But when you're talking about provisioning, this money is actually kept aside as a buffer just in case the loans fail. The reason why I've explained this concept of provision is because a lot of candidates get confused between the concept of capital requirements, that is CRAR, with that of provisioning. Provisioning is actually the amount taken from deposits. It is actually kept aside. But CRAR is a concept which is something that is mandated by RBI to maintain as a capital to at least carry out new business. So banks should have this capital to carry out new business before they think about expansion of their activities. Also note the point that capital is actually less than that of assets. Obviously you don't have to have the same kind of assets as capital. Let's say for example you have a capital of 100 rupees, and if a banking company is actually running a business and a lot of money is circulating, depositors money is also involved here. It is only the interest about this depositors money that will actually increase this capital. So please note this point, do not get confused. That is why the capital adequacy ratio is just 9% of the total assets as per RBI's mandate. So the key takeaway from the fact that we have understood about CRAR is capital is not increased by deposits, we have to generate profits, and it is exactly for this reason during demonetization, despite having such humongous deposits, banks did not generate any profit or their capital did not increase for the same reason. Additionally, regarding capital, Basel norms also stipulated that capital conservation buffer, that is in order to ensure that capital is not eroded, another 2.5% of the total risk weighted assets is set aside, and for counter cyclical capital anything between 0 to 2.5% as the central bank wishes can be set. Now what is this counter cyclical capital buffer? Let's say in an economic activity there will be cycles. There will be a boom cycle and there will be a slowdown cycle. So between 2000 to 2007 we have seen economy booming, and because of this banks resorted to lending activities in a hope that they'll generate more and more returns, and this also led to reckless lending by a few banks. And in order to ensure that RBI has a control over such kind of reckless lending, counter cyclical capital buffer is also stipulated by RBI from time to time. This will actually act as a buffer when the cycle turns from boom cycle to slowdown cycle and the capital does not get eroded.
So these are the four banking parameters which were selected by Basel III. Let us have a look at them one by one.
So this Basel III committee has actually identified four banking parameters which are crucial for survival: capital, leverage, funding, and liquidity. Now let us understand each of these terms separately. Thus, we have seen the concept of capital as a banking parameter under Basel III. Now, the major problem for banks to expand their economic activity is the rising non performing assets since 2013, which peaked in 2018. So, in order to ensure that the capital is increased for further economic activity, in 2015, it was recognized that India's public sector banks require as much as 1.8 lakh crores for recapitalization. That is, infusing more capital into their accounts. Government should help them. This is the recapitalization program that government took up. So in this case, the government in 2016-2017 almost infused 70,000 crores and waited to see the response. However, it was still not sufficient for meeting the Basel III norms, and the performance was not up to the mark. So the government decided that now we should force the banks to directly mobilize capital from the market. So this is where banking consolidation, privatization, and every other issue comes into the picture. So the government said that banks should actually raise capital by issuing certain bonds, recap bonds, or the recapitalization bonds, which will give an interest rate of somewhere around 7%. So this was issued by the banks, but the problem is investors do not want to invest in poor performing banks. This is where the government realized that weak banks should be merged. So merger of banks and amalgamation of banks is done to actually garner investor confidence. Another controversial topic called the zero coupon bonds, where RBI expressed concern about the step taken by the government, is also important in this context. Just to know what is the mechanism here. So, in a zero coupon bond, the name itself indicates that there is 0% interest, but borrower issues them at a discount. That is, a 100 rupee bond is actually given to the person at 90 rupees. So, when the person wants to sell this, uh, he can go and sell it at 100 rupees, and that is the profit earned on a zero coupon bond. That is the 10 rupees profit. Of Punjab and Sindh Bank, government has actually issued 5,500 crore worth zero coupon bonds, and actually Punjab and Sindh Bank bought this. But the problem is it is not a discounted coupon, but it is bought at face value. That is, a 100 rupee bond is actually given in 100 rupees. So essentially, there is neither a profit nor a loss for either of the parties. But what um, Punjab and Sindh Bank achieved, or the government achieved in this case, is they abided by the Basel III norms. Instead of directly giving bank the money that is required for Basel III norms, it is given in the form of this accounting roundabout manner, which RBI has raised concerns about. So you just have to be aware of this development. Another important development is the Yes Bank issue, where we were talking about the additional tier 1 bonds. Now, what is this additional tier 1 capital? Let us understand. When we were talking about the capital requirements, you can further divide this capital requirements into two tiers, tier 1 and tier 2. So normally in tier 1, what is present is the normal shares that are issued to the market, and additionally you have something called the additional tier 1 bonds, which were in use in the context of the Yes Bank controversy. Yes Bank is a bank which was actually in use for its flawed economic model and was bailed by SBI. Coming back, apart from this tier 1, you also have tier 2 capital. Now tier 1 capital is actually the ordinary shares, or it is also called the common equity tier 1, common equity tier 1. And apart from this, you also have the additional tier 1 bonds. When you're talking about the tier 2 capital, it is basically bonds or any hybrid instruments. It is not important to get into the details. Now, why are we talking about this additional tier 1 bonds? Now, you have to remember two things about this additional tier 1 bonds. They are unsecured and they are perpetual bonds. Let's say once they are issued for perpetuity, that is, the bank will go on paying interest till eternity. There is no end to the time period where the bank will stop paying interest for this particular bond. So once the bank issues this, the interest rate will be slightly higher than the normal bonds. Once the bank issues this and it is traded in a secondary market, let's say from Yes Bank, a person X buys this and sells it in a secondary market. Now, why can't go to the Yes Bank and give this bond and say that I want my principal amount back? That is not how it works. So, this interest is the incentive for the investor here. Now, you might be wondering, why are the banks actually willing to pay more interest? Because of a clause. According to this clause, if the capital requirements fall below a particular limit, the banks are allowed to skip interest payments also. And the second thing is, in case the bank fails, they can be written off. So, this is the most controversial problem. Because of the specific issue of Yes Bank, nearly 9,000 crores worth of additional tier 1 capital was put in danger. So RBI's restructuring plan had to take this into concern. Now, beyond this, it is not important to know the details. We have discussed about capital, the first parameter of Basel III. Now we are talking about leverage ratio, which is nothing but a ratio of the tier 1 capital, which we have discussed in the previous slide, as a ratio of the total assets. All the loans that a bank possesses is the assets, the consolidated assets. So according to Basel III norms, this should be around 3%. Now, what does this indicate? It indicates the financial health of the particular bank. Higher the ratio, that is higher the capital, the more capacity it has to absorb external shocks. Now, when it comes to funding activities, it is quite possible that banks can source their funds through short term, or they can even go for long term. Now, if they go for a short term funding, it creates a lot of volatility. Now, the concept of net stable fund rate says that all the activities and the businesses conducted by banks should be based on a 1 year horizon. That is, there should be a stability or sustainability of the fund sources. It is not like just to meet the capital requirements, short term loans are taken for high interest and it makes the business unsustainable. So, NFSR is that measure. Beyond this, it is not required to do more analysis on this. Now, how much is the requirement of NFSR according to Basel III norms? It is 100%. Now, another important factor which is related to this is the liquidity. In this context, you have to know something called liquidity coverage ratio, which is nothing but a measure of the resilience we have for short term. That is, how much liquidity we have for short term, that is 30 days. And in Indian context, this is more or less similar to the statutory liquidity ratio. More or less, there is an overlap between SLR assets and LCR. Now, what does the economic survey say? If you take a look at this peak, it is in 2017-18. In 2018, we have reached the peak of gross non-performing assets. Now, if you want to know the net non-performing assets, if you remove the amount included for provisioning of these loans, then it is called net non-performing assets. Now, what does this graph imply? Now, there is a possible question about NPAs here. So, you have to note that public sector banks have the highest quantity of NPAs, followed by NBFCs and then private banks. Another important observation is regarding the stressed assets. Now, you know that stress is something that is abnormal. In a normal situation, if everything is going well, then it is called a standard asset. Stressed asset is something additionally beyond NPAs. When we were discussing about the definition of NPAs, we talked about special mention accounts. That is between day 0 to day 90 from the due date. If people are not paying up the principal and interest, or if the companies are not paying up principal and interest, they are categorized as SMA accounts depending on the number of days. So NPAs along with SMA are called stressed assets, and this has slightly increased. You can use this Venn diagram to remember that NPAs are a part of the stressed assets. And finally, you can see that from this graph taken from the economic survey, the capital adequacy ratio has consistently increased. What does it indicate? Resilience of our banking system. Resilience of our banking system. So, these are the updates from my side as far as the banking capitalization is concerned. In the next video, we'll be talking about the prompt corrective action, how the insolvency and bankruptcy code functioned over the past few years, and what are the steps taken by the government with respect to the concept of bad bank, and what do you mean by this bad bank, etc. So if you like this video, please like, share and subscribe. And also, if you think this is adding value, please switch on the bell icon so that you can wait for the next update on this particular video. I'll be sharing this PDF on the Telegram group, the link for which will be placed in the description box below. That's it for now. Thank you.